webinar with Asset Reliability Inspections. I'm Jillian Fernandes from Investability, and it's my pleasure to be hosting today's session. Joining us are key members of the company's leadership team: Neil Young, Chief Executive Officer; Chris Hepwell, Chief Financial Officer; Russell Scrimshaw, Chairman; Matthew Hunter, Non-Executive Director; and representing AVC Enterprises is Alexander Commons. Thank you all for being here today. I'll now hand over to the team to commence today's presentation.
Thanks, Jillian. Good morning, everyone, and thanks for joining us. It's great to see you all again. Today, we'd like to give you an update on how we are going with building the ARI business into a national player. The guys have been really busy on the ground, bought a business on the east coast of Australia, which means that we've doubled revenue and almost doubled EBITDA in a short space of time. So the management team's been extremely busy integrating that acquisition, which we bought 100% of. And I'd also like to introduce you guys to our new Chief Financial Officer, Chris Hepwell, who's an experienced SME CFO. He's a chartered accountant and he's had 3 years at Rangedale. So he brings significant experience, expertise, and great visibility to the board in terms of the business and how it's tracking. And with that, wanted to hand you guys over to Russell for a quick overview, and then Russell will hand to Neil, the Chief Executive Officer and founder of ARI, to take you through the details of the presentation. And sorry, before I hand to Russell, wanted to also thank Spire Capital for their continued support and guidance throughout the investment horizon. Thanks, Russ.
Okay, thank you, Alex. Hopefully everybody can hear me. Good afternoon to you. Pleasure to spend some time with you this afternoon. Since we managed to bring Aben into the fold last year, we've realised we've inherited a pretty good business. We've had a few challenges, which you'll hear the team talk through in just a minute. We're doing quite a bit on some of those challenges, including cost challenges, but nevertheless, we've inherited a pretty good business with some great wins already under our belt, and you'll hear more about that coming up. Chris Hepwell, as Alex just said, has joined us, and he's doing a lot to improve our systems, especially with the new accounting system on the way. Chris is right on top of things in a very short order. So we've got a team that's doing a mighty job, I think, given the environment that's out there, and we've had to divert a fair bit of attention to Aben to integrate it, but nevertheless that hasn't slowed our momentum, we don't think. Neil Young and his team, unfortunately Nick is not here this afternoon, but Neil, Colm and Nick have been doing a terrific job at building the business. So we're very confident about the future. We're very confident in the opportunities that are in front of us, many of which are already being realised, and the market is certainly there for us on a much broader front than perhaps we thought a couple of years ago. So without any further ado, and with that as a little bit of background, let me hand over to our CEO, Neil Young, to take you through our progress.
Thank you, Russell. Thanks to everyone for giving their time today. I'll jump straight into it. So this is just an executive summary, and I'm going to unpack these 5 points further along the presentation. But the goal of buying Aben was to become a national provider, and this is being recognised by our clients, which is fantastic to see. Most notably, the WA footprint is enabling rapid response. So we've got the largest available pool of resources in Western Australia, with branches in Port Hedland up in the very northwest, Bunbury the very south, and the metropolitan area of Perth. So we've got a rapid response for unplanned breakdowns, and I'll give you some examples on what that's looking like from a revenue point of view. This is turning into commercial wins. So organisations such as Downer, CivMec and Talus are now offering us national service agreements. They want a single provider, they want standardised reports, they want the same charge sheet, and they want a mature relationship, and we're able to give that to them now. That's then turning into some opportunities strategically with the question of these national service agreements to be, well, what about Queensland? And we're aware of Queensland, and we're in some early discussions with some opportunities there. Queensland's very exciting for us because there's metalliferous mines throughout Queensland and the rail networks that support them, and that's our strengths. So we know exactly what to do, and we'll be in Queensland very, very soon. Further to that, the other fantastic opportunities we've got ahead is with the existing clients that will tier 1 clients that we'll have to bring together. So that's the Fortescues, the BHPs, the Rio Tintos. So now that we've got the integration under control and the trust of the clients under the new management and the new structure, we're able to now start offering those cross-selling of the services, which we're going to realise that in FY26. So that's leads into the last point, the commercial and operational performance. So we are about $1 million ahead of revenue forecast from the high end for the revenue forecast, and we're about to just start to unpack and realise some of those cross-selling opportunities, which is all very, very exciting. The snapshot of the combined business might have been obvious to everyone who invested, but me as a founder, my mind's blown by the strength of the business and what we're looking at, and we've only just started getting started. So we've got 160 employees. Both client cards combined is 1,700 clients with the largest Australian-owned TIC supplier, which is fantastic with the geopolitical discussions at the moment and resonates really well with the defence. We've got distracted competition. 3 out of the 5 majors have recently gone through an M&A themselves. The difference between their M&A and our M&A is that they've all been acquired by organisations that aren't TIC companies. So our competitors are now being managed by businesses and managers that are from overseas and that don't have any experience managing TIC companies. And as a result of that, we're seeing disgruntled staff and customers, and of course we're there to capitalise on some of the human capital that's being made available due to poor done integration and customers that aren't happy. Over to carbon neutrality, we were the first business of our type to get that done in Australia. There's now 3. This is incredibly important for tenders and provides other commercial opportunities. It's just as important as gender equality, local participation, and Indigenous participation. So we'll always be the first, and that's how I see this business as a leader. We're dynamic. The team that we had flashed up before, Chris, Colin, Nick, myself, and Brianna, we can turn on a dime still, and we've still got that founder mindset, which means we can react. The larger companies are really hard to turn, and they have restrictions, which is what we've got the next part there. They've got frameworks pushed upon them from ownership, or frameworks from being a 100-year-old business. It just makes them slow and unresponsive. And of course, the high demand, which is what attracted probably most of you to this business anyway. We've got the compliance, the regulation aspect of it, and we've got the aging infrastructure. Further to that, we recently undertook a process from Massachusetts Institute of Technology, MIT, to review the business for artificial intelligence. It was twofold. We wanted to make sure that we weren't at risk of being disrupted, and we also wanted to make sure that there was no opportunities to be disrupted and capture more market share. So absolutely, with Ariana, which is the ARI All Needs application, the heartbeat of the software that we use to manage our entire workflow system, we are using it for repetitive tasks, administrative tasks, computer vision reading, and the like. But the way that we collect the data, it's in difficult spaces. It requires certified persons. It's confined spaces. It's at heights. It's hanging by a rope and stuff. So the really good news for investors and people working in the industry is that robots aren't going to take our job in this sector. So it's excellent that we've got a future. We've had lots of momentum in financial year 25, and these are going to pay. We'll show the returns in the balance sheet for financial year 26. So the most notable is the resecured FNG contract, which was 50% of the Aiden revenue. Now, under the new management, 6 weeks after we did the deal, we spoke with FNG and said, these rates haven't moved since 2019, and that moved into a contract negotiation, which was executed last month. To resecure that was just an amazing achievement and shows the capability of the new team. For the record, the original vendor wasn't part of the process, so it's the new bench, it's the existing bench, not the vendor we acquired. And the charge rates are about 15 to 20% higher than what we were doing. We were very conscious to incorporate rise and fall clause, which wasn't there, which is why the rates hadn't changed since 2019 with the current inflationary world that we're going to be living in. Of course, we've got wages inflation and a few other things, which probably means the drop through profit is about 8%, but that's a 7-year contract, 3+2+2. So really happy to beat the drums on that one. We're also ahead of forecast. So we put together the IM for that capital raise, and we're just over $1 million ahead of the revenue. So we're really proud of that. And but we also have higher costs than expected. We know what those costs are, and we feel that they're absolutely contained within this revenue year. And it's mostly due to integration drag. It's taken longer than what we thought, but it's important to get right. So whilst we watch the majors rush integration and disrupt their workforce and disrupt their clients, it's incredibly important for us to get this right, to make sure that our clients and our workforce don't feel disruption and everything goes smooth. We'll talk about that a little bit further with the finances and why we know that it's contained with this financial year. Pilbara synergies. So we mentioned that we've got a really strong foothold in Western Australia with the north, the south, and in the middle capability. ARI has supplied in 6 months $500,000 worth of labour for ABN to meet its clients' needs in the northwest Pilbara. What we have is clients have unplanned breakdowns due to ageing infrastructure and the like, and we need to be able to respond fast. Quite simply, to supply $500,000 worth of labour in the current skill shortage it's just an impossible ask, and ABN wouldn't have been able to do that on its own. And by doing that, we've now got lots of word of mouth and momentum in the region. The integration and the brand unification's on track. Whilst it took a little bit longer in some areas, it got to a point where obviously the 1st of July makes sense with Chris Hidwell coming along with the new My Advanced system to come along. So we're in the process of just getting clean data, clean client contacts and stuff to move in there with individual P&Ls for all the branches. So that's the 1st of July. CRMs are already in there to make sure that no opportunities are lost. Both brands are using Ariana, which I'll talk about a little bit more. And we've got the key hires that we've done and positions in FY25. So obviously we've got Chris on board, who's got heaps of demonstrated experience with bringing businesses together and extracting the cost efficiencies of large buying power. And for me as a founder that's never had that type of resource, it's made a remarkable difference to the business, and I'm very excited. The other really key part is we were able to convince an existing known leader within the ARI branch to relocate to the Pilbara for 2 to 3 years with his family. These remote areas, to staff them, are incredibly hard, but the outcome, if you can do it well, is just tremendous. And by having someone there with ownership, someone who lives in the community, someone who's going to make the connections, attend the school sports in the region and the like, it's going to make a big difference to our operation up there. So we're incredibly excited for expanding the Pilbara. And again, we're just about to start that cross-selling now that we've got the trust from the clients for the integration. So I mentioned that Ariana is now being used in both businesses, which was great. And this is what we had to do. We had to get both businesses on the same systems before we could bring the two organisations together. It's hard to integrate if you're on different systems. The transition is too much. So that's there. Part of Ariana now is a government registered R&D project, and I'll talk about that in 2 slides time. But it's got to predict when faults are going to happen by us just recording when we find stuff. And it means that we're going to know our clients' assets better than they do, and it's going to bind the customers to us. It's going to make them sticky customers, and we want long-term mature customers and they'll pay for that service. The accreditations, the NADA, the radiation licenses and stuff, these are all things that we consider our license to operate. All of these organisations have been briefed and they're aware of what's happening. There's some cost savings to go to a national model and stuff. Again, these will be realised next financial year. And then finally, the trademark. So the ABN acronym and the logo, there have been cases where trademarks are resurrected from the grave and can damage people when they've stopped using them for mergers and acquisitions. So we've trademarked that just to protect ourselves for the future. And on the right hand side there, we've just got our existing framework of where we've got physical locations.
And just from just in terms of the Ariana, for the benefit of our investors that joined us as part of the ABN technical acquisition. So Ariana is the ARI All Needs application, and it's a system that has been internally built by Nick, Neil, and the team. And as a financial sponsor, I've really never seen. I've heard management teams talk a lot about technology solutions and investing in a tech solution to build internally. And I've always been a real skeptic around, businesses that aren't technology businesses making their own technology. But this really flies in the face of that theory. The guys have done an excellent job building the Ariana system, and they're actually using it. And we can see that it has delivered cost and revenue synergies to the business already. So well done, Neil and Nick, for building this application.
It's part of the reason we were able to, Chris talk, some redundancies and, administrative processes. And as a national company, it means that we can all jump in from anywhere in the country to help with reporting and invoicing and the standardization. It manages safety observations, it manages payroll with timesheeting, it's scheduling the workflow when we acquire an invoice, manages our skill sets, people's inductions, what levels of qualifications, what they can and can't do. So you can't schedule a person onto a job if they don't have the right license to do it. Equipment, it's a web-based application. It's based on PHP coding, which is the same coding that Facebook's made out of. So you imagine how many users and the scale of something like Facebook, and we've used the same thing. So it's not going to become redundant and stitch us up anytime. And then it's a key point of difference to our competitors. We're just such a niche industry that there's just nothing out there that really met all of our needs. So this is why we made the decision to build it. When it comes time to potentially look to exit, our competitors will be very, very interested. Just got some screenshots here just showing you what's going on with the login on the top left there. The top middle is just the job register. So there's a number, the client, the description, and the status of the job. So we've sent a price, the job's won, we've done the work, but it's not yet reported. It's reported, but not yet checked. It's not invoiced. So we've got the status of every job on the dashboard for anyone who's got the internet connection. We use the planner resources for scheduling. It's all in one spot. That's the top right, and then at the bottom left, we've got the leadership dashboard with our KPIs that are there. Like, and the KPIs are, how fast are we getting the report out from when we do the job, and how fast we get an invoice out from after the report, and the likes there. And the 3D reporting tool is basically the part of the R&D. So that there is a bucket. It's called a bucket, and it goes on the end of an excavator that digs dirt. And we can do any part in the machine, such as a boom on the excavator or stuff. And we literally put a dot where the crack or the defect is, and the time, how many hours it's been in operation for. And we're collecting this data on all these different types of machines for all these different types of clients around the state. And basically we're collating that data, and it's going to show us where the same item is failing and at what stage. So if you imagine a time lapse from the 0 hours brand new to end of life, we'll be able to go through a time lapse and just see exactly via a heat map of the frequency where these items are failing. Why would the client be interested about this? What it means is that when we currently go to site, we inspect something from top to bottom, and 50, 60, 70% of the areas we inspect, we find nothing. So if we've got some reliable data to de-scope that, it means the clients can put their machine to use quicker. So instead of giving us the machine for a day, we only need it for 3 hours, and it means that machine can keep operating. And when the machines are operating, it's hundreds of thousands of dollars per hour because they support 10 trucks, and those 10 trucks support crushers and other processing plants and stuff like and the like. So yeah, with some data, intelligent data, driven decisions to de-scope or scope areas for inspection, and we're going to have the IP for this, and it's all very, very exciting. And our technicians are collecting the data to build this data set without even knowing it. So there's no additional work. There's not years of R&D, and we're going to wonder where it's going to work. The technicians are giving the report of the location of the defect, and the same data is just being collated to map it out later. So very exciting stuff if you're someone like me, or responsible for the maintenance of a mine. And these are some of the new opportunities that are coming through the door. Obviously, we've got FMG up there. We had to put that one there as a win because, yeah, it's $22 million over 3 years. So we've got to celebrate that one because the team worked hard to get it. For those with an eye for detail, if we look at client 8, the $100,000 to a $1 million revenue range, I can explain that too. This is when we get an audition. So we go to a client and we can show them our reporting or our skill set, our workflow management. So sometimes people are comfortable with the devil they know than the devil they don't. So we get an audition and we'll do the audition, and that's why we get the $100,000, the lower end. I'm incredibly confident that we nail our auditions, which is why we're $1 million ahead over the revenue forecast from the IM and stuff like that. So that's why we got the broad brush on the range for some of them, because we've got to get through the audition. But the pipeline is strong. We did notice that coming out of the Christmas New Year period, there was an absolute influx of people that wanted to spend their budgets before having to do new budgets. Chris, I'm going to hand it over to you, mate.
Thank you, Neil, and great to be here today. So I've been in the business about 3 months now, so I've been spending some time around the different branches and getting to know a lot of people, and certainly enjoying that. A lot of capable people within the organisation. Some of our systems are great and some of them probably need a little bit of work, and that's what we can all get on with and achieve. But I do think that both businesses are pretty solid businesses. It's just a matter of some tweaks here and there and extracting the value which you can see in front of you, which I think we can achieve. So we forecasted out the remainder of FY25, and we're coming in at a total revenue of 28.8 mil. So obviously that's a fair step up from the 9 mil done in FY24, having the one business. From there, we're forecasting out the next 2 years with pretty consistent revenue growth of 12 and then 15%, which sort of gets us to that 37 million in FY27. From an EBITDA point of view, an adjusted EBITDA, we're expecting to come in around 10% this year. So down obviously certainly down on budget and down on previous year. As Neil sort of mentioned, certainly bringing another business into the team, it is a reasonably complex process to have to go through. Having said that, we know what the costs are, we have identified the opportunities, and we truly believe that 17-18% is achievable as we move forward in the next couple of years. So we've identified a number of synergies, I guess, that quickly get us from 10 to 15%. And it's really been done fairly exhaustively on the ABN side of the business, and we can take you through some of those. But we are rolling out a number of initiatives across the business, and certainly the new accounting system being a large part of that. So the new accounting system, we've got a go live date of 1 July, and that so we've already set up the branch structure, the cost code structures, all these sort of things. So that will give us fantastic visibility once we start pumping out these reports come end of July. So profitability around jobs will be very clear to see which jobs are making money and which jobs aren't. And also combine that with productivity reporting. We're basically we're a people-based, revenue-driven business. So when we combine that with the productivity reporting, we do think it'll start to paint a very clear picture whether or not a particular job has a productivity problem or a complexity problem or a rates problem or what have you. It's going to become really evident really quickly with the improved reporting. So we're certainly excited about that. I know I am. Yeah, so solid businesses, it's just about extracting that extra opportunities now. So you can see that dip in the graph there. You can see the fantastic revenue growth, but you can also the dip in the green line, the EBITDA line. But we do think it's a bit of a blip in the radar as we're putting these two organisations together. Just move to the next slide now, please. So this is just the ABN business alone, just to give you an idea of the business that's just recently been purchased and how that's stacking up. So at an adjusted EBITDA level, we're going to come in at around 9%. So you can see, revenue's okay. It's continuing to bubble along in terms of revenue growth, but EBITDA adjusted wise, it's okay as well. It's come slightly off the 10% to 9%. But we have identified significant synergies of about 1.5 million. When you add those back in, we get to around synergised EBITDA of around 19%. So it's that's the opportunity for the business. And we'll just take the next slide. I can sort of elaborate a little bit on what these are. So we have already completed some redundancies, and these were only done sort of last month. But annualized basis, that's going to save the business around 340,000. So they're complete, they're done. We have further redundancies to come once we sort of understand, particularly the finance side of things, and maybe a couple other operational type roles. But there are further redundancies which we have identified with the new accounting systems and improved processes, which is going to save the business around another 310,000. As Neil mentioned, we have recently signed the FMG contract, and on a fairly conservative sort of basis, that's going to produce around another $300,000 EBITDA annually. We're also doing a pretty extensive review of our current locations and offices. We do believe that we probably don't need 2 offices in Melbourne. Merging that office is a pretty quick and easy win. That'll give us around another 60-odd thousand. And that's likely to probably occur in the next 6 months or so. Vehicles-wise, the business, this particular ABN, has been spending a lot of money on repairs and maintenance and running I'd say, a very old fleet of vehicles. Some of the vehicles have done 250-odd, 300,000 kilometres. So quite a lot of older type of vehicles. So we've already replaced 3 here in Melbourne. We'll continue to look at that, certainly up in Port Hedland as well. I think we're looking at replacing some there. So we expect that repairs and maintenance around the vehicles to reduce significantly once the new vehicles are in play. We're also hiring a vehicle on occasion up at Port Hedland, so we can just simply by having 1 extra vehicle parked there, a newer vehicle. I think that's a 30-odd grand saving on its own. Consumables, we are spending a lot of money on consumables. So again, just being a bit more structured around how we manage the consumables, both ordering and getting these, things like uniforms, etc., to staff, how often, all those sort of things. So we think there's a significant saving there to be made. And then just the cost control in general. So we've recently developed a pretty simple sort of chart on limits of authority. So all the staff are aware of their limits of authority. On the back of that, Nick, who's, as Alex and Neil have mentioned before, is amazing to work with and very, very capable in terms of developing systems and processes. So he's actually developing an expense purchase requisition, which will be raised in the system, in the Ariana system, which will then push to the new MyOn and create a purchase order. So having a really structured purchasing process, I think, there's easily $100,000 to be saved in this business line. And that's really that can that's from the go live of 1 July, we'll start to see those savings. We're also looking at the radiography to move that to digital. We are spending a lot of money on film. I think it's in excess of probably $500,000. So we think if we make that shift, it's a pretty easy saving of around $300 a year. So we see that synergised when you make these savings. There's a synergised EBITDA which gets that business quickly up to 4.3 mil. So that's sort of how we're quickly stepping to 15% EBITDA from a group perspective. And there we think if we get after these things like productivity reporting and rates reviews and common rates and these sort of things, we still believe we can step from 15% to 17% next financial year and further from there. So a lot of positives still in the business.
Thanks, Chris. And look, I just want to emphasise that we don't have a revenue problem, which is that's the worst type of problem to have. And yeah, the delays with some of these redundancies and stuff, we really had to understand the business that we purchased before we could go in and do some of these cuts and make these improvements. But yeah, I am positive that this is all going to be contained within financial year 25.
And also, Neil, sorry to cut in, Chris, just to follow on what you were saying, Neil, around one of the reasons that we were attracted to ABN Technical was because we thought it had an overstated cost base. There was many people in their finance function, many people across operations. And so having a sort of cost synergy program was always part and parcel of the purchase of ABN. It's just taken us a little bit longer to extract those synergies than anticipated.
So with the IM, that went out for the capital raise, we've mapped out the revenue for, this year, the forward years. So we're still absolutely on track for all of that, which is $10 million worth of organic revenue growth to FY27. That's a 20% increase for next year, and then the 15% for financial year 27. We've unpacked that to work out how we're going to do that, and that requires 34 blue-collar staff to generate that level of revenue, and 34 staff need somewhere to base themselves, so that's 2 new footprints. The further M&A, we're keeping that option alive. That's also in the IM, delivering another $3 million worth of EBITDA in financial year 26, and then we'll look to extract some of those cost synergies, standardization, and the like for the FY 27. How are we going to do it? We've got the Ariana, the workflow management system that's repeatable and standardized across the country. We've got the MyOb Advanced rollout, and cloud SharePoint for data storage. We've got the commercial discipline there, the standard charge out rates. It's all fed through Ariana, and then through something called APIs, talks through to the MyOb Advanced system, such as exactly the same as that new expense or request form that Chris was talking about. Sales and marketing, a new web page, some salespeople on the East Coast, and then salespeople to drum up business again on the West Coast. So it's no longer just word of mouth. We're actually just actively hungry getting after these opportunities. The governance and compliance, the unified quality, health, safety, environmental accreditations, the NADA, the 9001s, and consistent group-wide procedures. These are essential in business today. It's essential for pre-qualification, and we're in the TIC sector, so we're expected to have these accreditations. People and pay, we're looking at the standardization of our pay structure, and that's got to be in the form of an enterprise bargaining agreement. We've started the process. We've got some drafts coming out. Chris needs it for his forecasting of revenue for budgets for the next 3 years. We need it to stop the noise, with the workforce, and we also need our remuneration on public display to attract staff too. And then all of that comes into the financial control with individual cost centers being developed and people being held accountable. So we didn't have those financial controls or that level of oversight with 2 founder businesses, both circa $10 million revenue. But now that we've come together, it's absolutely essential. So the entire C-suite got together to map this out. The revenue growth, the headcount required, the locations required, and it wouldn't be in these slides if we weren't confident that we can do it. Alex?
Thanks, Neil. Just to summarise where we're at, the EBITDA of 4.3 million is the synergy adjusted EBITDA, and we think that the cost extraction program will take about 6 months. But nevertheless, I've used that as the base for 2025. Organic growth to reach 6.6 million of EBITDA by 2027. We've assumed that we purchase another business for 3 million of EBITDA in 2026, and that grows hand in hand with the core business to reach 10 million of EBITDA by 2027. And then we'd be looking at selling into a forecasted EBITDA of 13 million in 2028. And if we were to deliver that outcome and we were to sell at a multiple of 8 times, predicting multiples is a challenge, obviously, because that number could be higher, that number could be lower. But that's an estimate based on where some of the domestic and international competitors are either trading at or transacting at, would deliver a share price of $5 a share. That being said, if the multiple is less than 8 times and we obviously don't get our EBITDA forecast of 13 million, then that share price could be lower. In terms of updating you more tangibly on where we are with the unit price and the share price, we're getting an independent valuation done of the business in June, based on the June numbers. It normally takes 1 to 2 months to actually get that independent valuation report ready. At that time, we will be coming back to you with an updated unit price, which takes into account the run rate EBITDA, market multiples, and the balance sheet items that the valuers take into consideration. So that was it for our ARI update. You can see that the team's been really busy and just done a tremendous job taking us from being a founder-centric, family-run business under Neil's leadership to a much larger emerging leader in the TIC space. So real kudos to Neil and the team. Nick, who's not here today because he's actually quite sick, fell ill this morning. Otherwise, he would have been here with bells on. And yeah, you guys can really see the progress that we are making with the business. And we look forward to sending you this report as well as the recorded video and your updated NAV statements throughout the course of this week. And then, as I mentioned, we'll be sending an independent valuation of the share price and unit price based on the June results. And that'll probably come through in July or August. I've got one question that's come through. Is there an ideal profile of an M&A target? Thanks, Dale. So that was from Dale, Spire Capital. That's a very good question, Dale, and one that we talk about as a board every time we meet. So, and I think it's really a healthy.
Looks like we've just lost Alex. I might have a go at answering it because we do talk about it at every board. We haven't narrowed it down yet. We've got the options that are very much open. So the options are an international TIC company that wants to enter the Australian and Asia Pacific and China space. And that is quite likely, especially with the Virginia class submarines and defence, with the relationship with defence such as that. Two of the major M&As that have happened recently have been from major TIC companies being sold to engineering companies, such as SRG and Enemec. So we've got organisations such as Monadelphous, Downer, and several others that may be looking to replicate that move to expand their services. Also, they've got the opportunity for a major who's already in Australia to expand their presence. And then, of course, there's the ability for another financial sponsor to do it. So the options are still there. We haven't closed off any. We think the most attractive would be an overseas organisation entering, and then the next likely would be one of those engineering companies to follow suit to add TIC to their services.
Yes, that's a really good question. It's one that we talk about as a board all the time. And in the next month or two, we're really going to drill down on what an M&A target really looks like from here on in, whether it's another asset integrity specialist or whether it provides testing services into a different market vertical, because either option is open for us now. For the last 6 months, we've really been focused on integrating ABN, but for the next month or two, we're really going to sharpen our pencil around what the next acquisition target looks like. All right. Well, thank you everyone for joining. As I said, video will be distributed to you shortly, as well as your NAV statements and the updated independent valuation of the company. Thank you everyone for joining. Thanks to the ARR team.